The Ŝoʊlz, ʻblæk, or Ŝoʊlz Merton model is a mathematical model of a financial market containing derivative investment instruments. From the model, one can deduce the Ŝoʊlz formula, which gives a theoretical estimate of the price of European-style options. The formula led to a boom in options trading and legitimized scientifically the activities of the Chicago Board Options Exchange and other options markets around the world. LT is widely used, although often with adjustments and corrections, by options market participants. Many empirical tests have shown that the Ŝoʊlz price is fairly close to the observed prices, although there are well-known discrepancies, such as the option SMILE. The Ŝoʊlz model was first published by Fisher Black and Myron Scholes in their 1973 paper, The Pricing of Options and Corporate Liabilities, published in the Journal of Political Economy. They derived a partial differential equation, now called the Ŝoʊlz equation, which estimates the price of the option over time. The key idea behind the model is to hedge the option by buying and selling the underlying asset in just the right way and, as a consequence, to eliminate risk. This type of hedging is called delta hedging and is the basis of more complicated hedging strategies such as those engaged in by investment banks and hedge funds. Robert C. Merton was the first to publish a paper expanding the mathematical understanding of the options pricing model, and coined the term Ŝoʊlz options pricing model. Merton and Scholes received the 1997 Nobel Memorial Prize in Economic Sciences for their work. Though ineligible for the prize because of his death in 1995, ʻblæk was mentioned as a contributor by the Swedish Academy. The model's assumptions have been relaxed and generalized in many directions, leading to a plethora of models that are currently used in derivative pricing and risk management. It is the insights of the model, as exemplified in the Ŝoʊlz formula, that are frequently used by market participants, as distinguished from the actual prices. These insights include no arbitrage bounds and risk-neutral pricing. The Ŝoʊlz equation, a partial differential equation that governs the price of the option, is also important as it enables pricing when an explicit formula is not possible. The Ŝoʊlz formula has only one parameter that cannot be observed in the market: the average future volatility of the underlying asset. Since the formula is increasing in this parameter, it can be inverted to produce a volatility surface that is then used to calibrate other models, e.g., for OTC derivatives. The Ŝoʊlz world. The Ŝoʊlz model assumes that the market consists of at least one risky asset, usually called the stock, and one riskless asset, usually called the money market, cash, or bond. Now we make assumptions on the assets. The rate of return on the riskless asset is constant and thus called the risk-free interest rate. The instantaneous log returns of the stock price is an infinitesimal random walk with drift. More precisely, it is a geometric Brownian motion, and we will assume its drift and volatility is constant. The stock does not pay a dividend. Assumptions on the market. There is no arbitrage opportunity. It is possible to borrow and lend any amount, even fractional, of cash at the riskless rate. It is possible to buy and sell any amount, even fractional, of the stock. The above transactions do not incur any fees or costs. With these assumptions holding, suppose there is a derivative security also trading in this market. We specify that this security will have a certain payoff at a specified date in the future, depending on the value taken by the stock up to that date. It is a surprising fact that the derivative's price is completely determined at the current time, even though we do not know what path the stock price will take in the future. For the special case of a European call or put option, ʻblæk and Scholes showed that it is possible to create a hedged position, consisting of a long position in the stock and a short position in the option, whose value will not depend on the price of the stock. Their dynamic hedging strategy led to a partial differential equation which governed the price of the option. Its solution is given by the ʻblæk-Scholes formula. Several of these assumptions of the original model have been removed in subsequent extensions of the model. Modern versions account for dynamic interest rates, transaction costs and taxes, and dividend payout. Notation: let be the price of the stock, which will sometimes be a random variable and other times a constant. The price of a derivative is a function of time and stock price. The price of a European call option and the price of a European put option. The strike price of the option. The annualized risk-free interest rate, continuously compounded. The drift rate of annualized. The standard deviation of the stock's returns. This is the square root of the quadratic variation of the stock's log price process. A time in years, we generally use now equals 0, expiry equals t, the value of a portfolio. Finally, we will use to denote the standard normal cumulative distribution function. Will denote the standard normal probability density function, the ʻblæk-Scholes equation. As above, the ʻblæk-Scholes equation is a partial differential equation, which describes the price of the option over time. The equation is. The key financial insight behind the equation is that one can perfectly hedge the option by buying and selling the underlying asset in just the right way, and consequently, eliminate risk. This hedge, in turn, implies that there is only one right price for the option, as returned by the ʻblæk-Scholes formula. ʻblæk-Scholes formula. The ʻblæk-Scholes formula calculates the price of European put and call options. This price is consistent with the ʻblæk-Scholes equation as above. This follows since the formula can be obtained by solving the equation for the corresponding terminal and boundary conditions. The value of a call option for a non-dividend paying underlying stock in terms of the ʻblæk-Scholes parameters is. The price of a corresponding put option based on put-call parity is. For both, as above, is the cumulative distribution function of the standard normal distribution. Is the time to maturity. Is the spot price of the underlying asset. Is the strike price. Is the risk-free rate. Is the volatility of returns of the underlying asset. Alternative formulation. Introducing some auxiliary variables allows the formula to be simplified and reformulated in a form that is often more convenient. The auxiliary variables are: is the time to expiry, is the discount factor, is the forward price of the underlying asset, and with D plus equals D1 and D minus equals D2 to clarify notation. Given put-call parity, which is expressed in these terms is the price of a put option is. Interpretation. The ʻblæk-Scholes formula can be interpreted fairly handily, with the main subtlety the interpretation of the terms, particularly in why there are two different terms. The formula can be interpreted by first decomposing a call option into the difference of two binary options. An asset or nothing call minus a cash or nothing call. A call option exchanges cash for an asset at expiry, while an asset or nothing call just yields the asset and a cash or nothing call just yields cash. The ʻblæk-Scholes formula is a difference of two terms, and these two terms equal the value of the binary call options. These binary options are much less frequently traded than vanilla call options, but are easier to analyze. Thus the formula breaks up as: where is the present value of an asset or nothing call and is the present value of a cash or nothing call. The D factor is for discounting, because the expiration date is in future, and removing it changes present value to future value. Thus is the future value of an asset or nothing call and is the future value of a cash or nothing call. In risk-neutral terms, these are the expected value of the asset and the expected value of the cash in the risk-neutral measure. The naive, and not quite correct, interpretation of these terms is that is the probability of the option expiring in the money, times the value of the underlying at expiry F, while is the probability of the option expiring in the money times the value of the cash at expiry K. This is obviously incorrect, as either both binaries expire in the money or both expire out of the money, but the probabilities are not equal. In fact, can be interpreted as measures of moneyness and as probabilities of expiring item, in the respective numeraire, as discussed below. Simply put, the interpretation of the cash option is correct, as the value of the cash is independent of movements of the underlying, and thus can be interpreted as a simple product of probability times value, while B is more complicated, as the probability of expiring in the money and the value of the asset at expiry are not independent. More precisely, the value of the asset at expiry is variable in terms of cash, but is constant in terms of the asset itself, and thus these quantities are independent if one changes numeraire to the asset rather than cash. If one uses spot S instead of forward F, instead of the term there is, which can be interpreted as a drift factor, the use of D- for moneyness rather than the standardized moneyness. In other words, the reason for the factor is due to the difference between the median and mean of the log normal distribution. It is the same factor as in ITO's lemma applied to geometric Brownian motion. In addition, another way to see that the naive interpretation is incorrect is that replacing n by n in the formula yields a negative value for out-of-the-money call options. In detail, the terms are the probabilities of the option expiring in the money under the equivalent exponential martingale probability measure and the equivalent martingale probability measure, respectively. The risk-neutral probability density for the stock price is as defined as above. Specifically, is the probability that the call will be exercised provided one assumes that the asset drift is the risk-free rate. However, does not lend itself to a simple probability interpretation. Is correctly interpreted as the present value, using the risk-free interest rate, of the expected asset price at expiration, given that the asset price at expiration is above the exercise price. For related discussion and graphical representation, see section Interpretation, under Data Matthews' method for real option valuation. The equivalent martingale probability measure is also called the risk-neutral probability measure. Note that both of these are probabilities in a measure-theoretic sense, and neither of these is the true probability of expiring in the money under the real probability measure. To calculate the probability under the real probability measure, additional information is required: the drift term in the physical measure, or equivalently, the market price of risk. Derivations. A standard derivation for solving the ʻblæk-Scholes PDE is given in the article ʻblæk-Scholes equation. The Feynman KAC formula says that the solution to this type of PDE, when discounted appropriately, is actually a martingale. Thus, the option price is the expected value of the discounted payoff of the option. Computing the option price via this expectation is the risk neutrality approach and can be done without knowledge of PDEs. Note the expectation of the option payoff is not done under the real-world probability measure, but an artificial risk-neutral measure, which differs from the real-world measure. For the underlying logic, see section Risk-neutral valuation under rational pricing, as well as section Derivatives pricing. The Q-world under mathematical finance. For detail, once again, see Hull. The Greeks measure the sensitivity of the value of a derivative or a portfolio to changes in parameter value while holding the other parameters fixed. They are partial derivatives of the price with respect to the parameter values. One Greek, gamma, is a partial derivative of another Greek, delta, in this case. The Greeks are important not only in the mathematical theory of finance, but also for those actively trading. Financial institutions will typically set limit values for each of the Greeks that their traders must not exceed. Delta is the most important Greek since this usually confers the largest risk. Many traders will zero their delta at the end of the day if they are speculating and following a delta-neutral hedging approach is defined by ʻblæk-Scholes. The Greeks for black Scholes are given in closed form below. They can be obtained by differentiation of the black Scholes formula. Note that from the formulae, it is clear that the gamma is the same value for calls and puts, and so too is the vega the same value for calls and put options. This can be seen directly from put-call parity, since the difference of a put and a call is a forward, which is linear in S and independent of sigma. In practice, some sensitivities are usually quoted in scaled-down terms, to match the scale of likely changes in the parameters. For example, rho is often reported divided by 10,000, vega by 100, and theta by 365 or 252. As a V, extensions of the model. The above model can be extended for variable rates and volatilities. The model may also be used to value European options on instruments paying dividends. In this case, closed-form solutions are available if the dividend is a known proportion of the stock price. American options and options on stocks paying a known cash dividend are more difficult to value, and a choice of solution techniques is available. Instruments paying continuous yield dividends for options on indices. It is reasonable to make the simplifying assumption that dividends are paid continuously, and that the dividend amount is proportional to the level of the index. The dividend payment paid over the time period is then modeled as for some constant. Under this formulation, the arbitrage-free price implied by the Black-Scholes model can be shown to be and where now is the modified forward price that occurs in the terms, and extending the Black-Scholes formula adjusting for payouts of the underlying instruments paying discrete proportional dividends. It is also possible to extend the Black-Scholes framework to options on instruments paying discrete proportional dividends. This is useful when the option is struck on a single stock. A typical model is to assume that a proportion of the stock price is paid out at predetermined times. The price of the stock is then modeled as where is the number of dividends that have been paid by time. The price of a call option on such a stock is again where now is the forward price for the dividend-paying stock. American options. The problem of finding the price of an American option is related to the optimal stopping problem of finding the time to execute the option. Since the American option can be exercised at any time before the expiration date, the Black-Scholes equation becomes an inequality of the form with the terminal and boundary conditions, and where denotes the payoff at stock price. In general, this inequality does not have a closed-form solution. Though an American call with no dividends is equal to a European call, and the Rollgesker-Whaley method provides a solution for an American call with one dividend. Barona-Deci and Whaley is a further approximation formula. Here, the stochastic differential equation is split into two components: the European option value and the early exercise premium. With some assumptions, a quadratic equation that approximates the solution for the latter is then obtained. This solution involves finding the critical value, such that one is indifferent between early exercise and holding to maturity. Bjerksund and Stensland provide an approximation based on an exercise strategy corresponding to a trigger price. Here, if the underlying asset price is greater than or equal to the trigger price, it is optimal to exercise, and the value must equal. Otherwise, the option boils down to a European up-and-out call option, and a rebate that is received at the knockout date if the option is knocked out prior to the maturity date. The formula is readily modified for the valuation of a put option, using put-call parity. This approximation is computationally inexpensive and the method is fast, with evidence indicating that the approximation may be more accurate in pricing long-dated options than Barona-Deci and Whaley.